Hello and welcome to Deal Flow, the show that explores the world of mergers and acquisitions. I'm Erica van der Merwe. The automotive manufacturing industry represents 7% of South Africa's gross domestic product and an estimated 30% of manufacturing jobs in South Africa. Trinitas Private Equity, a mid-market South African-based private equity player, recently has become a player in this sector. It bought a 70% share of the auto industrial group from its former German owners, ZF. More about that deal in a moment. First, let's hear from Timishu about our deals of the week.
Thanks, Erica. Let's take a look at those deals for the week. South African furniture group Steinhoff offered to increase its holdings of struggling subsidiary JD Group to 98% to rescue the household retailer from challenges in both the consumer and credit market. And in other deals, China's largest internet company, Tencent, has agreed to spend $180 million on a 15% stake in online services provider Leju Holdings. Now, this is stepping up its rivalry with fellow online heavyweight, the Alibaba Group. And Britain's Tesco has sealed a joint venture agreement with the unit of India's Tata Group that will see it invest $140 million and become the first foreign supermarket to enter the country's $500 billion retail sector. And finally, BlackBerry has reached an agreement to sell the majority of its real estate holdings in Canada. Well, this is part of a plan outlined earlier this year that is aiming at bolstering the technology company's balance sheet. Well, those are your deals of the week. Back to you.
On this week's Deal Flow, we'll be looking at a deal which saw South African-based mid-market private equity firm Trinitas Private Equity take a 70% stake in one of South Africa's leading automotive component manufacturers, the Auto Industrial Group. The local management team has taken a 30% stake in this business. In studio with me to discuss this transaction further, Soteris Theoridis, a founding partner of Trinitas. Welcome, Soteris, and congratulations on this deal.
Yeah, thank you very much, Erica.
I think there's been talk that deal making in the South African private equity industry has been slow, but you've been steadily at it. How long has it taken you to do the due diligence on this deal and to make the final decision?
Well, Erica, we started, it was actually run as a process, the disposal, and we got the information memorandum in March last year. So it's taken, and the payaway was in February this year. So it's taken us a year to go down the road. So as you can see, the deals take, deals, and good deals in particular, take a long time to conclude.
So why was this a particularly good deal? What were the elements that you looked for? So is it about chemistry with management? Is it about the valuation? Is it about the prospects and so on?
Well, Erica, it's a deal that Trinitas and we like in the sense that it's a very asset-rich company. It's a company that's been around for a long time, 45 years. The management team is established, got a good reputation. The CEO's been there for 20 years. It's a business that is quite dominant in its particular space. It's got significant market share, and obviously the core of private equity. I mean, it's a very strong cash generative asset.
So this is a sizable business, a turnover of 650 million rand, staff of 800. So even though you're mid-market, this is a hefty deal that you've done.
It is, and I guess one of the concerns or discussions initially was whether we syndicate or look for possible syndication of the transaction. In the end, we didn't have to do that. But the business, comprising two foundries, a forge, and a machining and assembly facility, 50,000 square meters under roof is substantial. I mean, the replacement cost of the facility is in excess of R1 billion. So it's a very sizable operation, absolutely.
So you mentioned now you considered syndicating, in other words, getting another equity partner in alongside you, but instead you chose to take 70%. Now that's, I understand, pretty unusual because typically private equity would be comfortable with a significant stake and a minority stake. So here's a significant majority stake.
Well, Erica, look, we're not particularly prescriptive on the stakes that we take. I mean, I think what we tend to focus on is developing an investment strategy which focuses on how we're going to get our return over the investment period, and that's typically 5 years. And I think what you want to have is influence in being able to achieve that return. So typically we would want a minimum 25% interest, and obviously key in the transactions as well is we want alignment with management as our operating partners. So you want them to have a stake as well, significant stake. So the equity or the stake would typically range from, our equity stake would range from 25 to 75%. Our shareholders agreement would be the same whether we held 25 plus 1 or 75. And as I say, we don't get involved operationally. That's management's role in the business.
I'm going back to so the selection of this asset. And I understand that the Trinitas approach is not a top-down looking at sectors that might be attractive. It's really on a deal-by-deal basis, bottom-up selection.
Yes.
But then presumably also take into account the other assets in your portfolio, so there's not sort of duplication really of sector exposure.
Sorry, the question is?
So your portfolio, presumably elsewhere you don't have an exposure either to automotive or to manufacturing?
Yes, absolutely not. We do have another manufacturing business, so it does bring an element of diversification into the portfolio. That does play a role, but I think in terms of the consideration of the investment, it comes down to the metrics of the transaction and whether there's sufficient value on the table for us to get involved. I mean, that's the primary driver of the analysis, absolutely.
Yeah. So that comes to pricing also, that presumably valuation comes into that. You mum on the valuation in your release on that, but is it difficult at this stage in the market where we seem to have this disconnect between pricing on the listed equity market and what the economy is doing? Are you seeing that in the mid-market space where you are looking for deals? In other words, are deals, do they tend to be pricey, and are they good ones hard to come by?
Well, look, the good deals are hard to come by. And unfortunately, what you're up against is the pricing proxies tend to be the listed market, so you don't get away from that. But yeah, I do think there is better value in that space, and there are significantly more value drivers in terms of what one can do with the underlying businesses, as opposed to, let's say, the bigger type transactions where you're paying higher multiples, and predominant driver of return in those type of transactions is debt. So if you take a look at this deal, we've got a lot more of a conservative capital structure, a lot less geared, and I think that was facilitated by the price that we managed to pay for the asset.
So the point you're making, and correct me if I'm wrong, is that this is not a sort of a financial engineering deal. It's really about bringing in other strategic and operational elements that the private equity manager brings to this transaction.
Yeah, absolutely. I mean, the business is conservatively geared. The investment strategy, as I mentioned earlier, is geared towards growth. So what we see is automotive production ramping up quite significantly over the next sort of 6 to 8 years, and us participating in that, and that used as a driver, and that's how our return is being driven, as opposed to the engineering or gearing elements of the transaction.
But on that point, if you were to be frank, I mean, is manufacturing in South Africa an attractive industry in which to be involved? I mean, there are all sorts of issues, labour issues, costing issues, competition, imported competition, currency fluctuation. So what are the risks for you in doing this deal?
Look, absolutely. I mean, I think there are challenges as you've discussed, but I'll go back to what I said initially. I think the key is to be getting in at the right price, the right asset. And what we found with this business as well is if you look at the capital expenditure cycle, I think over the last 5 years, over 300 million was invested in the operation. So there is significant scale and capacity going forward, and we are hoping that we've invested on the right side of that. So an attractive, it's got its challenges, but attractive if you've got the strategic advantages and competitive advantages that I touched on earlier. You know, the scale, getting in at the right price, structuring correctly, and the growth elements.
Who are the competitors to this business, to Auto Industrial? Are they local manufacturers, or is it indeed imported competition?
Yeah, so there's no local competitive scale at all. So the risk and the competition would probably be product substitution from elsewhere in the world. Although what you find as well with some of the OEs is that they manufacture the components in-house. But that's something they're moving away from. So they are looking at kind of outsourcing what Auto Industrial does. And in terms of product substitution, you must remember that the components that they manufacture, which are brake and chassis components, are safety components. So quality and safety integral to the process and not so easy to substitute elsewhere in the world.
Right.
Yeah.
So now you've said this deal takes you up to 60% of your fund, so up to sort of nearly 2/3 now of the capital that you raised in this particular fund that you have deployed.
Yes.
Do you have other deals in the pipeline? Any more announcements that are imminent?
Not imminent announcements. I think our plan is, as you mentioned, we're close to 60%. In terms of our partnership agreement, once we get to 75%, which is around 500 million, and we're at around 350 million spent of 670 million, you can then start raising money again. So I think our immediate focus is probably 1 to 2 new deals, this year with a bit of luck, possibly rolling into next year, and then I think kind of thinking about capital raising thereafter.
And presumably, so that's a completely different area of specialisation, the fundraising process. So you say you could start next year. In your opinion, what does the market look like for fundraising for South African funds?
Well, look, I guess there's 2 components to that question. I mean, the one is the local market for fundraising, and then internationally. So I think there's a reasonably finite pool of capital locally. So I think for Trinitas at 670 million, if we wanted to raise, call it $1 billion or $1.5 billion, we'd have to look at international money. Locally, I think we've got the support base, we've got the track record with the investors, but there's probably only so much that we can raise. I think the challenge would be to internationalize the offering, and I think there you're competing with a whole lot of other elements. It's not only a South Africa only story, there's a big African story, as well as emerging market story.
Indeed. Well, thank you for those insights, Soteris. Good to talk to you. And that's it for this week's edition of Deal Flow. Thanks to Soteris Sioridis. He's a founding partner of Trinitas Private Equity. Do tune in again next week to get the latest news and views on mergers and acquisitions. Until then, from me, Erica van der Merwe, it's goodbye.